So you're worried about those US tariffs hitting Alberta and wondering how it's going to affect the Calgary real estate market? Well, I don't blame you. The uncertainty is hanging over our heads right now, and it's all that you're hearing.
We begin with breaking news out of the White House, where US President Donald Trump has signed tariffs on imports from Canada, Mexico and China, America's top trading partners. Now, a 25% tariff is imposed on Canadian goods, with a 10% levy placed on Canadian oil exports.
But if you don't make your product in America, then very simply you will have to pay a tariff.
While there's uncertainty, there is no urgency, as the effects won't be immediate to our real estate market if and when they do take effect. Now, if this happens, here's what you need to know about Calgary's unique position while other provinces face potentially bigger challenges. Today's plan is to discuss 6 main influences in our local market if tariffs come into effect. And then we're going to jump into the stats, what happened last month in the Calgary real estate market. Now, remember to download this month's free market report. The links are all in the description. So what are the main influences that can steer our market over the coming year? Well, the first one is interest rates. So let's talk about interest rates. They're probably the biggest factor and one thing that most people are thinking about because we've already seen 5 cuts by the Bank of Canada starting in June of 2024. And by the end of next year in 2026, we're looking at 60% of all Canadian mortgages coming up for renewal, with 40% facing higher rates. In Calgary alone, when we extrapolate from the national data, we could see around 85,000 mortgages renewing this year in 2025. That's a lot of homes kind of thinking about renewing, interest rates, and what's going on. Well, here's some good news. The bond market has been showing signs of improvement. It kind of jumped back a little bit this week, but when, on Friday, when we had the tariffs that were coming at our doorstep, the bond was sitting around 2.7, 2.8. And come Monday morning, it actually dropped to 2.5. Now, this is a pretty big move when it comes to the bond market. So fixed rates are tied to the bond market and variable rates are tied to the Bank of Canada's number, right? So when the bond market is moving, and if we saw it go down to that 2.5, usually it's like around 1 to 1.5% above that is where fixed rates are. So we could have, if it stayed there, started to see interest rates, fixed interest rates, get under 4%, literally by the end of the week. Now, BMO actually said, and they put out a report, that the Bank of Canada could possibly do 6 more drops of their rates, 0.25 each time, and get us all the way down to 1.5% for the Bank of Canada rate. Now, that's a really aggressive drop, but all this is saying is tariffs would have kind of like across our country, tariffs would have a really negative effect on our economy. And so we'd have to really, the Bank of Canada only has one thing to move to really make this work. And as long as inflation isn't skyrocketing, they are going to lower the interest rates to kind of keep things more affordable. But again, tariffs aren't happening right now, but if they did, this is probably what we could expect. Now, the second thing is a lot of people, when it comes into an uncertain time, they kind of put on hold some of the big purchases. Now, this could be cars, this could be houses. Now, how many people that aren't going to make these big decisions really is unknown. And how many people pause it really is unknown. However, there are still many people, despite the uncertainty in the market, that would happen if the tariffs come in over the next 30 days or within 30 days. They're still going to make moves. People still make moves during this time. It might just slow down. Now, CREB has said that they're forecasting about 26,000 sales over this year. So it could eat into that a little bit, but it's really, really hard to know. So if this happens, you need to find agents that you can trust, that you can work with, that really have your back and know the data. And they're not just trying to put you into any type of home. Actually, you should be doing that anyways. So the third thing is new builds. So one of the things that could change in our market is the cost of new builds. So with a record number of 22,600, a little bit more than that probably, but 22,600 housing starts in 2024 here in Calgary, what could happen for new builds this coming year? we could potentially see maybe 10, maybe 15% of costs of building homes increase. So builders, they're not just like so polite. They're going to be like, you know what? I got you on this one. No, they're not going to do that. They're going to pass that on to you, meaning the prices of new homes are going to rise. Now, if that happens, we could see, despite having the advantage of a 30-year amortization for new builds right now, the government has done that, and that's something you can do. When you go buy a new build, you can do a 30-year amortization. Buyers possibly could actually start moving towards resale options because new builds have gotten a little bit more expensive. And they already are kind of priced right at the top right now in a lot of areas. So there's still a lot of people looking at resale homes versus the new builds. So if this happens and prices of new homes go up, that increased demand in resale could then possibly lead to increased prices in the resale market. Now, to tie into the cost of new homes is the cost of renovations. So whether you stay in your new home or you move to another property this coming year, if you're thinking of staying and renovating and kind of improving your property, well, that could actually go up too if tariffs come into effect. Again, this is just basic cost. How much? No idea, but it's something to be aware of that cost could also increase. So the fifth thing that would happen to our economy is employment. Now, US tariffs on Canadian goods will most severely impact Ontario, Quebec, and British Columbia due to their concentrated, manufacturing, aerospace, forestry sectors, and Ontario facing hundreds of thousands of potential job losses, and BC's GDP potentially declining by 0.6% annually with prolonged tariffs. So those provinces are going to feel it way more than I believe, and I've had tons of conversations with people and a lot of research over the last couple days and over this last weekend. And let me tell you, I really believe those provinces are going to feel it way, way more than Alberta would, because Alberta is facing still a moderate risk from the 10% tariffs that could come on oil, gas exports, and food processing. Now, Saskatchewan, Manitoba, they're somewhat protected because they're diversified economies and growing steel manufacturing sectors. Atlantic Canada, Nova Scotia, all of them out there, they also have a lower risk because they're limited manufacturing, right? And they're growing in some of their tech sectors. So a 10% energy tariff versus 25% in all other areas could preserve some of Alberta's job growth in oil and gas, supporting Calgary's appeal to workers from provinces with weaker economies. And if this all takes effect, if there are weaker economies and there's a stronger economy, that leads to migration, and that's number 6. Now, CREB estimates interprovincial migration could stabilize at around 1.9% in the provincial population growth in 2025. In 2024, it was actually forecasted to have a 5.6% growth in population, and for 2025, CREB is predicting for Calgary a 3.1% growth. That is still a lot of people. So if tariffs come into effect, Calgary could see that 3% go lower if there are job losses occurring in energy, manufacturing, or construction due to the tariffs. However, with that record number of new builds, over 22,000 housing starts in 2024, if population growth slows a little bit, that may actually improve affordability, but it's hard to say fully as many of these homes are probably already purchased. But are they going to be lived in? We've had a history of many of these new builds being purchased by out-of-province speculative investors hoping for easy appreciation, so many could hit the resale market too. A lot of these could come on the market and they're vacant, brand new properties. Now, regardless of the new builds, population growth of any kind could help us sustain demand for Calgary housing. And truthfully, Calgary's benchmark home price remains so much lower, 40-30% lower than Vancouver and Toronto, which is still attracting cost-sensitive migrants. Now, here's your main takeaways. First one, mortgage renewals and interest rates. We could see interest rates drop a lot more in the coming months as long as inflation is kept in check. Again, only if tariffs come into play. New construction impact. Building material costs could increase 10 to 15%, potentially driving buyers towards resale properties and affecting market prices. Employment. Alberta faces moderate risk from 10% tariffs on oil and gas exports compared to other provinces, like Ontario and BC, they face more severe impacts in manufacturing and forestry sectors if tariffs come into effect. Now, population growth. Calgary's population growth is expected to slow from 5.6% in 24 down to 3% in 2025, with potential further decreases if these tariffs actually came into effect. But remember, as we saw this week, there was such a ramp up of nerves going into the weekend. And then come Monday, everything kind of just calmed down. And today, I'm shooting this on Tuesday, to be honest. So if something happens on Wednesday, Thursday, Friday, I wouldn't be surprised because patience and clear thinking are our best tools right now. And a steady approach is going to serve you so much better than a rushed decision. This is something we've talked so much about in our channel. Making that steady approach is going to serve you so much better than making rushed decisions. So, what is the market doing? Let's look at the data. So let's start with benchmark pricing. So the benchmark pricing in Calgary has gone down to $583,000, which is down 0.05% from last month, but actually up 1.87% from last year. Now, we ended up, and that's where this is right here. So you can actually see there's a little bit of a flattening line that's kind of happening. And because, again, we only went down 0.05% from last month, that's the reason you're seeing that flat there. And the other thing that to notice is how much more inventory is sitting on the market. Now, the number of inventory is actually sitting at 3,639, and that's the blue line right there, where the sales are at 1,451. The year-over-year inventory, if you look at January this year compared to last year, we are actually sitting 69% more inventory than last year, which is okay, really. Again, 3,600 listings is still low. It's still not a lot of listings, and I'll jump into that and show you here in a moment. Now, when you look at all of the different price ranges, the benchmark price ranges around the city, you can see most all of them actually, yes, all of them are a year-over-year upgrade. The lowest one is in the north at 0.1% year-over-year. And then you have City Center at 1.1%, and everything else is above that. Northeast is then the next one at 2.5%, and everything else is 3, 4, 5% more. So when you're looking at surrounding areas, this is actually detached benchmark prices compared to Calgary. So Calgary's is at $750,800 right now, where in Airdrie it's $636,000, Cochrane is $658,000, Canmore is at $1.6 million. Okotoks is at $692,000, High River $555,000. Oh, there's Calgary's $758,000, and then Strathmore's at $530,000, and Chestermore's at $792,000. Everything has gone up for detached properties year over year. Calgary's is actually 7% year over year with the largest growth. Yes, and it's prices are higher. Let's say that. Easier to say that. Now, number of new listings. So the number of new listings, this is probably the highest number of new listings that we have seen in, for sure, a couple of years, because you got the yellow at 2024, the green at 2023, bright blue right there at 2022, and all the other colors kind of mixed together. But at this number of new listings on our market, this is a good thing, right? This is a good thing where there's more inventory coming on the market, more options, because there's still demand in our city. And when you look at the number of sales, the sales are actually still really high. We have more sales this month than we did in 2023, which is the bright green. However, we're less than 2024. So we're right in the pocket still of a lot of sales happening in the city. But yes, sales year over year for Calgary are 12% lower than last year. But again, we're higher than the year before that. And all of these years have just kind of been busy, right? A lot of market, a lot of things happening in our market. And so to me, if this number of sales was actually down in this section where we're like under 1,000 sales, that is then concerning, because that's kind of showing, oh, there's a real lack of demand. If more comes on and they're just not getting bought, there's a problem. But that's not the case. So when you look at the actual inventory, we're sitting right in the middle. Now, the last 3 years are all clumped down on the bottom there. Because inventory, again, 69% more than last year, and last year was the green line right here. But again, like Look at all these years of so much more inventory. Again, if we had 5,000 inventory or more, then the whole city probably would be in a balanced market, but we're not. We're still technically in a seller's market. Now remember, we have a market update guide that goes through so much more detail than what we're talking about here in this video. So jump in the description, grab it, and we will see you inside that guide with all the details. But the actual thing that we want to talk about is months of inventory. This is one of my favorite stats to be able to help understand what the market is doing. And the months of inventory, months of supply right now in Calgary is sitting at 2.51 months of inventory. Now, that essentially, technically, is into a balanced market. 2.5 is the benchmark, so 2.51, well, now we're in a balanced market. But really, it's really still flirting with that, and we're really, really tight to that seller's market still. At any point, a push of more sales could drop that down into kind of lower two numbers, right? So we have been kind of flirting with this number right around that 2.5 all the way back to September. So August was 2.05. Yeah. So like we're sitting around kind of August, September, that all fall has been sitting right around this 2.5 months of inventory. Now, when you look at, I'm going to make a line here for you. When you look at the zones across the city, the only two zones that are sitting in a balanced market overall is the Northeast and the city center. So Northeast, I truly believe there's a lot of properties on the market that were like bought as rentals or are rentals and people just trying to offload them. But now that's kind of turning into a different type of market where there's more balance in there and they're not seeing turnover as quickly as they have before. Whereas in the South and Northwest, you're probably having it's fast. I mean, if you have the whole zone at 2 months of inventory, that's pretty wild. I mean, we've seen wilder, that's a word, wilder. But overall, the city is sitting in kind of a seller's market. And so when you look at price points, this is where it gets also kind of interesting. So this line is I'm going to do my best. I can't see the whole thing, but let's pretend that's pretty good. Look at that, 2.5. So as you can see, price points, all of these price points, I mean, you have little ones in here, like the 300 to 350 range, the 350 to 4, you've got 750, you've got 850 to 9, all the way up pretty much to about here. And at that point, that's 1.1 million. So everything price-wise in the city under 1.1 million, for the most part, is sitting also in a seller's market. So we still only have a few pockets, and some of these lower ones, this is probably going to be a lot of condos, right? A lot of those condos sitting in that 300 price range. The 750 and the 850, these are detached houses where they're kind of potentially some properties that should be priced maybe at $699 and they're sitting at $757 or something. People trying to get more than what it's actually worth. So it's kind of inflating some of these numbers too. So really, most of the market under 1.1 is sitting in a seller's market in the city. And so when you actually look at the off market to sales, this is something we introduced a couple months ago, and we're still kind of tracking it and looking at it. The reason that I said there's more rentals and people being a little bit more excited, presumptuous, hopeful in the Northeast market is this number right here. This number right here, 100%. So what this is the yellow line on the bottom here is off market. The red is sold, and the green is your active number of listings. So there was as many properties pulled off the market, expired, terminated, withdrawn, whatever, as there were sales in the Northeast last month. So remember, if you want to get more information about the market, what's going on, you want to book something with us to find a time to talk about the market, do that. All the links are in the description. But if you want more stats, jump in that video and we'll see you there.